Okay, picture this. You're holding a winning lottery ticket, but instead of cashing it in, you're just sitting there watching it slowly burn to ashes. Well, if your money is just sitting in a normal bank account right now, that is exactly what you're doing. Welcome to this explainer. Today we're stripping away all that confusing Wall Street jargon and breaking down the stock market step by step. By the end of this, you're going to be able to confidently make your very first trade.
Let's kick things off with a fun little hypothetical. Imagine someone handed you $1 million today, no strings attached. You want to play it incredibly safe, right? So you park the whole thing in a typical big bank savings account, which earns an average interest rate of about 0.1%. Take a guess. How much money is that entire $1 million going to make you in a full year?
$100. Yep, that's literally it. You have $1 million to your name, but it is barely lifting a finger for you. Honestly, you could probably find $100 in your couch cushions over the course of a year. And here is why that's a massive financial emergency. When you contrast that tiny 0.1% bank yield against a typical inflation rate, which has been around 5% over recent years, you aren't just breaking even, your cash is actively losing its purchasing power. Stashing cash under the mattress or in a standard bank account is basically a guaranteed mathematical way to become poor over time.
Which perfectly sets up Section 1, the hidden cost of cash.
Let's visualize this. Take the US postage stamp as a perfect example of inflation in action. The exact same stamp, offering the exact same service of mailing a letter across the country, cost just 8 cents back in 1971. Today, that identical stamp costs 73 cents. The stamp hasn't changed at all. The value of the cash used to buy it has just plummeted.
So, how do we actually outpace this invisible wealth killer? Well, the answer is the stock market, specifically the S&P 500, which is an index tracking the 500 top companies in the US. Since its inception, this index has historically produced an average annualized return of 8 to 10% per year. It is absolutely your ultimate weapon to beat inflation.
And when you combine that 8% return with time, you get the absolute magic of compound interest. That's just the interest you earn on your past interest. If you start with $5,000 and consistently invest $1,000 a month for 30 years, you'll contribute about $360,000 of your own money. But your final balance? Boom, over $1.5 million. That massive towering difference is simply your money going to work for you.
All right, so we know why we need to invest. Let's move right into Section 2. What are you buying?
You know, Wall Street loves to use overly complex terminology, but the reality is actually incredibly simple. A stock is just a single slice of ownership in a real, living, breathing business. You aren't buying some abstract digital lottery ticket. You are buying a tiny claim on a company's actual assets and their future earnings.
To really visualize this concept, just think of a company exactly like a pizza. The entire pizza represents the whole company. The total cost to buy that entire pizza is what we call the market cap or market capitalization. And a single slice, that's one share of stock. When a company issues stock, they're really just slicing up their pizza to sell to the public so they can raise money to grow.
And just like pizzas come in different sizes, so do companies. You've got your massive mega and large cap companies like Apple and Microsoft, valued at over $10 billion. They're highly stable, but they might grow a bit slower. Down at the total opposite end are microcaps, valued at under $300 million. These are your wild penny stocks. They have huge room to grow, sure, but they carry a much higher risk of completely failing.
But here's the catch. How do you know if you're overpaying for your slice of pizza? That's where you use the PE ratio, or price to earnings ratio. Think of it as a simple price tag. It tells you exactly how many dollars you have to pay for every $1 of the company's profit. A high PE means investors expect huge future growth, so they're willing to pay a premium. A lower PE? Well, that might mean you're finding a value deal on a stock that's currently on sale. Now that you know what you're buying, let's jump right into Section 3, picking your strategy.
When you're ready to put your money to work, you generally face two main paths. First up, picking individual stocks. This is high risk, high reward. I mean, if you correctly pick the next NVIDIA, you're going to make an absolute fortune. But if you pick a company that goes bankrupt, you lose it all. The alternative is index funds. This is where you buy a single fund, like one tracking that S&P 500 we talked about, that instantly buys you tiny slices of 500 different companies. It's instant diversification, and frankly, it's the secret to that steady 8 to 10% historical return.
Before we get to the actual trading part, we need a really quick jargon check.
If you ever turn on the financial news, you're going to hear the terms bull and bear constantly.
Here's a fantastic visual trick that'll help you remember these forever. A bull market means prices are rising. Why? Because a bull thrusts its horns up into the air when it attacks. A bear market, on the other hand, means optimism is low and prices are falling. Why? Because a bear swipes its heavy claws down when it strikes. It's that simple.
Okay, let's bring all of this together in Section 4, making your first trade.
Getting started is literally as easy as online shopping. Step 1, open a brokerage account with an app like Fidelity, Vanguard, or Robinhood. Step 2, transfer some cash from your checking account. Step 3, find your stock and choose your order type. And Step 4, hit execute.
But wait, actually, scratch that. Before you do step 1, you have to choose your account type. You can open a standard taxable brokerage where you pay taxes on all your profit, or you can open a Roth IRA. Listen, a Roth IRA is an absolute superpower for beginners. You fund it with money you've already paid income tax on, but all the investments grow completely tax-free forever. If you make $1 million inside a Roth IRA over the next 30 years, you literally don't owe a single dime to the IRS on those gains. No way around it, it's incredible.
Then, when you finally get to the actual buying screen, you'll be faced with two main choices. A market order means you want the stock right now and you'll accept whatever the current price is. It's fast and it's guaranteed to go through. A limit order means you're willing to wait. You set a specific price tag, and the app is only going to buy the stock if the price drops to match your target. As we wrap up this explainer, I want to leave you with this really powerful quote from financial analyst Nick Maggioli. Rather than to worry about whether now is the right time to buy, just keep buying. History proves time and time again that time in the market always beats trying to perfectly time the market. Even if you buy on days when the market seems a bit overpriced, holding for 20 or 30 years virtually erases those short-term bumps.
Which brings us to our final, ultimate question. You now know that holding cash basically guarantees a loss in purchasing power. You know how compounding interest works, you know what a stock actually is, and you know the exact buttons to press to buy an index fund. The only thing left is action. So, are you ready to escape the savings trap and claim your slice of the pie? Thanks so much for joining me on this explainer, and I seriously challenge you to go open that account today.